Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to part 5 of what is now going to be my 6-part video series on Roth IRA conversions. In this video, we are going to kick off the next 2 major topics of the Roth IRA conversion decision and transaction. And the first one is how to calculate your estimated taxes on the conversion income. Because a viewer posted in the channel comments and she said that she did a Roth conversion last November. As soon as she did the conversion, she sent in the estimated tax payment. She sent in what she believed was the appropriate estimated tax payment. But when it came to tax time, she got dinged with the underpayment penalty. In fact, she says she actually mistakenly overcalculated the amount of estimated taxes due and sent in more than she really had to pay, ultimately resulting in a refund. But even with the refund, she still got dinged with the underpayment penalty. Now, you might be like, okay, wait a minute. How can you pay in more than you owe, get a refund, and then still get dinged with the underpayment penalty? Well, we are going to talk all about that in the first half of this video. Calculating your estimated tax payments. It's a topic that a lot of folks have been asking about on the channel, so now is the time to go over it in detail. Then, in the later part of the video, if you are doing Roth conversions, then you have got a decision to make. Are you going to pay the tax on the conversion income using, number one, cash that's coming out of the traditional IRA, meaning ultimately that less will end up in the Roth over time? Or are you going to pay the tax on the conversion income using outside funds? And what are the ramifications of each of these 2 decisions? What are the tax implications? What are the future cash flow and earning potential considerations? Basically, what should you be thinking about when deciding to use one source of funds versus the other, or some combination of both? By the way, if you enjoy this video, please like and subscribe, and let me know in the comments what's going on in your personal tax planning situation. All right, so we're going to kick off this video with a timeline, as we often like to do. This is a 1-year timeline broken out by the 4 quarters. We have January the 1st over here. We have December the 31st over here. Now, the IRS will assume that your income is generated pro rata, okay? Meaning evenly throughout the year. All right, your income will be generated evenly distributed throughout these 4 quarters, okay? That is the default. That is the IRS default assumption about income. And we're talking about any kind of income here. It could be wage income, it could be capital gain income, it could be Roth IRA conversion income, any kind of income. The default assumption is that it will be earned evenly throughout this year. Okay, everybody with me? Now, let's go here. So let's take wage income as the first example, because wage income is generally pretty easy to understand, pretty straightforward. Assume we have $120,000 of wage income for the year. What is the IRS default assumption going to look like? Well, it's going to look like $30,000 per quarter, okay? Pro rata, evenly earned throughout the year. Now, how is wage income generally earned, like in reality? How is it earned? Well, it's generally earned pro rata, right? Because like you typically get paid every 2 weeks or whatever. So in the case of wage income, here's what I want you to see. In the case of wage income, the reality of how the income is generated and the IRS default assumption are going to be the same, okay? The default assumption is this, and the reality probably looks just like this as well. Now let's go here. Now, what if you do a Roth conversion in November, for example? All right, so here's our timeline. Here's our wage income from the previous example being generated pro rata. Here's our Roth conversion income. Let's assume that's also $120,000. That's being generated in November, which is in Q4. Is the Roth conversion income being generated pro rata? No, it's not being generated pro rata. It's being generated in November. Okay, but what's the IRS default assumption? It's that the default assumption is that the Roth conversion income is being generated pro rata. Okay, that's all income. All income, the default assumption is that it's actually being generated pro rata, when in reality it's being generated over here in Q4. So let's take a look at the difference here on timeline 4. So let's compare what really happened to the IRS default assumption. So here's wage income. Wage income generally is earned pro rata throughout the year. So here's the reality of the situation. And then the default assumption will be the same, that the income is generated pro rata, just like we said. With the Roth conversion income, the reality is that, in this example anyway, it was generated in Q4 of the year. However, the default assumption will again be that it was generated pro rata throughout the year, just like the default assumption is that all income is generated pro rata throughout the year. So in this case, i.e., in the case of income that is not, in reality, that is not generated evenly throughout the year, the reality of the financial transaction and the IRS default assumption are not the same. Okay, now you might be asking, why? Why is that the IRS default assumption that all income is earned pro rata throughout the year? The answer to that is actually pretty straightforward, because you might assume that all financial information out there, all transactions that occur out there in the United States, that everything is reported to the IRS. But it's not. A lot of things are not reported. One of the things that is generally not reported is when things occur during the year. The total amount of income for the year is often reported in many cases, like on a W-2 or a 1099-R. The total amount for a given year is reported. But when things occur is generally not reported. For example, when you do a Roth conversion, you will get this form from your broker or custodian right here. It's called a 1099-R, and there will be a number here in box 1 right here. There may be numbers in some of these other boxes as well, but there will definitely be a number right here for the gross distribution, meaning the amount that you took out, the amount that you converted from a traditional into a Roth. That number is going to be here in this box. But if you look at this form, nowhere on this form does it say when things occurred. There's no dates on here as far as when this Roth conversion happened. This could be one Roth conversion. This could be two Roth conversions that happened at different times. This could be a Roth conversion every month, all lumped into one number, the total for the year. But when they occurred is not reported. So the IRS doesn't know when these transactions occurred. So what else can they possibly assume other than pro rata without any better information? And that is why we have the default assumption. All right, so with all of that in mind, let's start calculating our estimated taxes. And for the moment, let's just pretend that withholding is not a thing. If you have been a W-2 employee for some portion of your life, you may have never made an estimated tax payment before. Withholding may well have taken care of everything for you and gotten the money that you needed to pay into the government. All right, we're going to come back to withholding later in the video, but for now, let's pretend that it doesn't exist. So in this example, the only way to pay in what we owe in taxes is to make estimated tax payments. And that's how it would be. If withholding wasn't a thing, you would have to make estimated tax payments, which is what we're talking about in this video. So let's go down here to these bullets and understand the situation. So in the situation with wage income, how much do we have to pay in per quarter? So we have $120,000 of wage income. Let's put aside the graduated tax brackets and assume a flat 24% tax rate. Just to make the math easy for this example, we just want to get the concept down. We're going to start simple, and then we're going to lay on complication after complication like we always do. Let's put aside payroll taxes. We can worry about that later. we're going to deal just with the basic concept of making an estimated tax payment. How much do we have to pay in for quarterly estimates in this example? So as we can see here, we have $30,000 of income per quarter under the default assumption, which would mean that we'd have to pay in $30,000 times our marginal tax rate of 24% equals $7,200 would have to be paid in each quarter in this example. So $7,200 would be the estimated tax payment. Now, what if we layer in the Roth conversion that happened in Q4 so the actual income generation looks like this? This is the same chart that we were looking at before. This scenario here is what the viewer who originally posted the question appears to have done. She looked at the reality of how the income was generated and said, okay, $30,000 in Q1, that must mean an estimated tax payment of $30,000 times 24% is $7,200. It's the same $7,200 we saw up above. Same for Q2, same for Q3. But then in Q4, we have the $30,000 plus the $120,000 of the Roth conversion income. So she based her estimated tax payment on $150,000 of income in Q4 times 24% is a $36,000 estimated tax payment. And a lot of people who would look at this and go, oh yeah, that makes perfect sense. You generated the income here, you made the estimated tax payment here, and that's great. The Q4 estimate was based on the Roth income occurring in Q4. Is that the right thing to do? No, because what does the IRS default assumption indicate that you need to do? Well, let's go to the next chart here. It indicates that you need to base your estimated tax payments on the assumption that income is generated pro rata. So here's the wage income, here's the Roth income under the default assumption, leading to 30 plus 30 is $60,000 of income in each of the 4 quarters, multiplied by 24% is an estimated quarterly tax payment of $14,400. The default assumption is that you need to pay $14,400 in each of the 4 quarters. So if you only pay $7,200, like we calculated a few moments ago in Q1, Q2, and Q3, then you are late in paying your estimated taxes, and that's why you get dinged. So when you go back up here, you base it on the reality of the income generation. You are underpaid at $7,200 in these 3. The default assumption says you need to pay $14,400. You will hear people say that the U.S. tax system is a pay-as-you-go system. And that's true, but it can be misleading because if we go back up here, you're like, okay, well, this is how I go, quote unquote. Like this is the reality of how the income was generated. So I'm paying as I go. So what am I doing wrong? Well, you're not following the IRS default assumption. So under the IRS default assumption, your income is assumed to be generated pro rata, and therefore you must pay as you go according to that assumption. This is paying as you go based on the default assumption of the IRS. And that's where a lot of people get hung up and confused because they're not aware of the default assumption. Now, wait just a second. Something about this doesn't make any sense, does it? How can I possibly make estimated tax payments in Q1, Q2, and Q3 on a Roth conversion that I don't even know if it's going to happen until we get to Q4? Maybe I haven't decided if I'm going to do a Roth conversion this year at all. Maybe my financial situation is in flux and it's not clear the amount of the Roth conversion I will do, even if I know I'm going to do something, until we get to Q4. How in the world can I be expected to calculate and make estimated tax payments on future income which is unknown in amount or may not occur at all? Great question. And let's make sure we understand, like if you don't know that you're going to do this until Q4, or you think you're going to do it, but you don't know what the amount is going to be. And maybe the possibilities of what the amount could be are very variable. It could be like a wide range. And so how in the world are you supposed to make tax payments over here? It doesn't make any sense, does it? And that's a great question. So let's go back to the IRS default assumption. The IRS will assume that your income is generated pro rata unless, all right? And I'm going to put a big unless right here. Unless you tell them otherwise, okay? Unless you tell them otherwise. Now, how do you tell them otherwise? Do you call them on the phone and be like, hey, IRS, my income is not generated pro rata? Is that what you do? Nope, you don't do that. If you do that, you'll probably be on hold for like 300 years, which is annoying, and then they may still end up thinking that your income is generated pro rata. So that is not what you do. Instead, in a situation like this, you're going to make an election on your tax return when you file it, okay? Now, I know that might sound really complicated, okay? But it's super easy. Making an election is basically just checking a box on the tax return. You ever done that before? There's a box there. You put a check mark in it. You have made an election. Very simple. All right, now, what are you electing? Okay, you are electing the annualized income installment method. Okay, now hold on. I know that may sound really complicated, okay, but I am going to make it super easy. All right, here are the tax words. Okay, here's the tax words: annualized income installment method. Okay, that's what the tax nerds say. That's the tax words. Here is what it means in English. Hey, IRS, my income is not generated pro rata. Okay, that is what this means right here. When you elect this, when you check that box and you elect the annualized income installment method, that is how you tell the IRS, hey, my income is not generated pro rata. Okay, hold on, Justin. This all sounds really cool and like tax nerd kind of stuff, and that's great, but what is this doing for me? Okay, what does making this election accomplish? Great question. What it does is it says, I don't want the default assumption to apply to me for this tax year, because you can make this election each year. All right, I don't want this anymore. I don't want my Roth conversion income to actually occur over here and for you to just randomly assume that it's evenly spread out throughout the year. I don't want this anymore. All right, that's what making the election does. It says, stop thinking this, IRS, about my situation. I don't want this. I'm going to cross it out. What I do want is this. I want the reality. I want my estimated taxes to be based on what actually happened, right? And that makes a lot more sense. That goes back to maybe 5-10 minutes ago in the video. You're like, oh, it makes perfect sense. If I just paid the estimated taxes based on this, it would make a heck of a lot more sense than if I paid them based on this. The beauty is you can get this. You can get the IRS to think this instead of the default assumption. And to get them to think that, you have to make the election that we just talked about. And so again, your estimated taxes under that election will now be based on what actually happened and will not be based on the default assumption anymore, just like the viewer who posted the comment probably wanted. So here's the question. Did the viewer who described this scenario in the first place in the comments section do something wrong? Did she do something wrong? Well, you can kind of argue yes and no. I would say not actually with the estimated payment itself, right? Let's go back up here. She did this. This is what she wanted. She had the income in Q4. She made the estimate in Q4. This is what she wanted to have happen. But what she didn't realize is the default assumption is that. And so if she did anything wrong, it was that she didn't elect this. And if you elect this, then you can make the payments based on this. Paying in the full amount owed on the Roth conversion in November when it actually happened is fine, as long as you elect the annualized income installment method when you file your tax return. That is how you avoid getting dinged in a situation like this. So what this individual likely did wrong is not make that election. And remember that the IRS doesn't know when your transactions occur. So they're not going to just elect this for you if it happens to be more beneficial and allows you to avoid getting dinged. They're not going to do that. You have to know to elect this on your tax return. And as you should be able to see, this is also pay as you go. It's all pay as you go. It's just pay as you go under a different set of rules than what's applicable under the default assumption. But it's always pay as you go. It just depends on which rules do you want to apply to you. Do you want the default rules to apply, or do you want to elect this rule so that you can base it on what actually happened? Now, what is the next logical step after you elect the annualized income installment method? Well, you have to tell the IRS when your income was generated, right? I mean, you just said it wasn't generated pro rata. Okay, that's cool. So when was it generated? Well, great question. For that, let's go straight to the horse's mouth. All right, so here's a little snippet from the instructions to Schedule AI related to the annualized income installment method. If I scroll down here, these are from the instructions to Form 2210, which is the form that deals with the annualized income installment method. By the way, I just want to note that this Schedule AI, this has nothing to do with artificial intelligence. I know that AI is a big deal in the market these days, but this schedule just happens to be called AI by coincidence. It has nothing to do with this up here. So let's read this little blurb in the red square. If your income varied during the year, i.e. meaning it was not generated pro rata, because, for example, you operated your business on a seasonal basis, or you had a large capital gain late in the year, or you did a Roth conversion late in the year, i.e. in November, you may be able to lower or eliminate the amount of one or more of your required installments, i.e. your estimated tax payments. The words required installments and estimated tax payments means the same thing. You may be able to lower or eliminate one or more of the required installments by using the annualized income installment method. Use Schedule AI to figure the required installments to enter on this form right here. Okay, so in order to use this method and help us avoid getting dinged on the underpayment penalty, you need to tell the IRS when your income was generated. We talked about that. And that's going to be by quarter. We talked about that, similar to how you saw things set up on the timeline slides a few minutes ago. So by quarter, we're going to tell them when our income was generated. Let's go to TurboTax. So here is a screenshot from TurboTax showing how you tell the IRS what your income is by quarter. All right, this is going to be under the personal tax tab right here, other tax situations right here. And if you're using a different tax prep software, the setup will be similar, because how you enter this information that we're about to go over, that is an IRS thing. It is not a TurboTax specific thing. So if you're using another program, the screen might look different, but the concept and setup should be the same. Okay, so I'm going to go down here. This is where you're going to enter your annualized adjusted gross income in order to make this election. There's going to be 4 spots. right here, just like there were 4 quarters right here where we're going to put the income. However, when you're entering the information by quarter here, I'm going to give you 2 wrinkles that you need to be aware of, okay? Wrinkle number 1, for everything dealing with estimated tax payments, the 4 quarters in question are not 4 periods of time, each containing 3 months. Because why would they be, right? Like, why would anything make sense, all right? Sheesh. For everything dealing with estimated tax payments, the quarters are measured as follows, okay? Q1 is going to be 3 months long. Q2 is going to be 2 months long. Q3 is going to be 3 months long. And Q4 is going to be 4 months long, okay? So we have January 1 to March 31, April 1 to May 31, June 1 to August 31, and September 1 to December 31. And why is that? Well, it's a very complicated and boring answer related to the start date of the fiscal budget of the United States Congress. Yawn to that. For our purposes, we just need to be aware that this is how the quarters are measured, going back to at least the 1960s, so that we can determine our estimated taxes appropriately and not get dinged with any underpayment penalties. We're going to have to report our income in these increments like this when we want to elect the annualized income installment method. Okay, wrinkle number 2, when you enter your income into TurboTax or any tax software, because they will all be set up the same way, as I said before, you will not enter each quarter's income. Rather, you will enter the cumulative income year to date through the end of each quarter. Okay, now I know that sounds really complicated. Okay, so let's take a look at the snapshot again, okay? Here is January 1 to March 31, okay? So that's 3 months. So that's 3 months of income that I have put in this box. The next one, remember I said just a moment ago, we're entering cumulative income year to date through the end of each quarter, okay? So this box, this is not Q2. This is January 1 through May 31. So this is the first 3 months plus the next 2 months gives you a cumulative 5 months of income goes in this box. And then in the next one, remember I said Q1 is 3 months, Q2 is 2 months, Q3 is 3 months. So that's 3 plus 2 is 5 plus 3 is 8. That's 8 months of income goes in this box. And then finally, 12 months of income goes in this box right here. Although in TurboTax, you don't actually have to type that in. TurboTax will put your total amount of income that you have put in all places on the return, and it will automatically put it here. In some other software programs, you may actually have to type that in, so just be aware of that. Now, let's go back to our original timeline and modify it for what we have learned. So this is what I originally showed, and this is how most people will think about their income when trying to measure it by quarter. Note that the total income here is 240, okay? We have 120 in the wage income, 120 in the Roth conversion income. That's 240, okay? If I scroll back up here to TurboTax, that's what I have right here. I have put 240 in this tax return. Okay, now let's go back down here to the next box. This is how we're going to modify income by quarter for estimated taxes when we are doing the annualized income installment method. Okay, so Q1 had $30,000 and the cumulative amount is $30,000. Q2 had $20,000 because remember that Q2 is only 2 months long. So if I go back up here, this is what I originally showed you before this was like the base case, before we learned that the quarters are not 4 different periods of 3 months each. The quarters are 3 months of income, 2 months of income, 3 months of income, and then 4 months of income right here. So cumulative is 30, 30 plus 20 is cumulative of 50. 30 plus 20 plus 30 is cumulative of 80. And then finally, all of this is cumulative of 240. Okay? And that's how we get these numbers that go into these boxes in TurboTax. So that is how you make the election to use the annualized income installment method, which means that you are telling the IRS that your income is not generated pro rata. In fact, there is no actual box to check, like I said before. You just elect this by doing it, basically. So when you start typing numbers in here, you have made the election. And as I said, the result will be that your estimated tax payments will be based on how your income was actually generated and not based on the IRS default assumption, thus helping you to avoid getting dinged with underpayment penalties when you have income that is generated unevenly throughout the year, i.e. like from Roth conversions. Okay, let's keep moving forward in calculating some estimated taxes, and let's start by going straight to the horse's mouth. So here is the next question that we need to ask. How much needs to be paid in estimated taxes to avoid getting dinged with underpayment penalties? Okay, here is the URL to the IRS webpage where this information can be found. So how much needs to be paid in to avoid getting dinged? Well, here are the answers right here. At least 90% of the tax for the current year. So for example, if we are basing it on 2024, if we're doing 2024 estimated taxes, 90% of the current year would mean 90% of the tax that will show up on the 2024 return. Okay, another possibility is 100% of the tax for the prior year. So that would be 100% of the tax for 2023 in the example that we're talking about. So if we're doing 2024 estimates, it's going to be 90% of 2024 or 100% of 2023. And remember, these items right here, which you will see referenced by many people when they're talking about estimated taxes, this is for the whole year, but it still has to be paid in as you go by quarter up to the appropriate amount, which we have been talking about. Now, we're going to do some more robust examples showing all of that in just a second, but these are the basic rules. By the way, if you are going to use this second method right here based on a prior year, instead of 100%, it could be 110% if your AGI, your adjusted gross income, if your AGI on the prior year tax return, so in this case 2023, is above $150,000. That's the threshold. So if it's above 150, then you have to base your estimate on 110% of the tax. We're going to do examples of all of this in a second. So here's the basic rules. All right, let's keep going. By the way, these two thresholds are called safe harbors. All right, and a safe harbor means that as long as you pay in the safe harbor amount, you will not get dinged with underpayment penalties. Okay, so as long as you pay in this much, remember you have to pay it in by quarter. We're going to divide these numbers up by quarter in a little bit. You will not get dinged with underpayment penalties as long as you do that. Now, which of these two options is the safest, quote unquote, of the two safe harbors? Is it option one, the 90% of the current year tax, i.e. if you are calculating estimates for 2024, this means 90% of the tax that will be on your 2024 tax return? Is that the safest, quote unquote, of the two safe harbors? Or is it option two here, 100% of the prior year tax, i.e. if you are calculating estimates for 2024, this means 100% of the tax that was shown on your 2023 tax return, like we just said? Answer is option two is sort of the safest, quote unquote. Now, why is that? What makes it the safest? It's because option two is based on a number that is already known. In other words, by the time you're working on 2024 estimated taxes, your actual tax for 2023 is already fixed and known, and you have filed your tax return. In most cases, unless you file an extension, but we can get to that nuance later. Generally, you have filed your 2023 tax return, and so the tax on this return is known, and therefore 100% of that number, or 110% of the number, if AGI is above 150,000, that number is also known. Okay, so that's why I say this is kind of like the safest, quote unquote. Alternatively, option one, okay, which again is the 90% of the current year tax, that is based on a guess of what your 2024 tax liability will ultimately be. It may be a highly educated guess. It certainly could be a highly accurate guess if you do your calculations appropriately, but it is still a guess or estimate because you're trying to figure out your 2024 tax liability before 2024 is over. Let's go to example one. All right, estimated taxes example number one. Your 2023 taxes were $50,000. You can find this number on your 2023 Form 1040 line 24. Right here, this is the number we'll be using to base our estimates on. You're planning to do a Roth conversion in 2024. You estimate that you will do a $40,000 Roth conversion, but you're not 100% sure on the exact amount. The $40,000 is your best estimate at the moment. You estimate that all other income items like wages, pensions, Social Security will be roughly the same as the prior year, meaning 2023, at $210,000, i.e., so the only incremental income increase that you're expecting for 2024 relates to the $40,000 Roth conversion. Okay, you were in the 24% marginal tax bracket in 2023, i.e., since everything else is expected to be the same, the incremental Roth conversion income will fall into the 24% bracket. How much do you have to pay in estimated taxes for 2024? Well, first things first, what are your two options to calculate the estimates? Well, 90% of the current tax, option one, 100% of the prior tax, option two. Which one of these options will result in a lower safe harbor estimate? Meaning you don't have to pay in as much, but you'll still be covered by the safe harbor. Well, let's calculate both and see what we get. So let's start with option one. We are expecting $40,000 of Roth IRA conversion income plus $210,000 of income from everything else equals $250,000 of total taxable income for 2024. So here are the brackets and rates for 2024. We're assuming married filing joint. This is our projection of income right here. So let's just run through this real quick as a refresher. Remember that the first $23,200 will be taxed at the 10% rate. The next $71,100, okay, which is the top of this bracket minus the top of this bracket, all right, that amount will be taxed at 12%. The top of this bracket minus the top of this bracket, that incremental amount will be taxed at 22%. And then finally, this number right here is $250, which is our estimate, minus everything in the lower brackets, okay? And that will be taxed at 24%. So when we multiply these numbers right here by these amounts over here, here is the tax that we get, $46,085. Now, that's the first part of the calculation. Now let's go down here. So for 2024 safe harbor, option one, which is 90% of the current year, we're going to take the total estimate of the 2024 tax, which we just calculated right there. We're going to multiply it by the safe harbor threshold of 90%, and we're going to get safe harbor estimate option one, $41,477. Okay, so just to recap that real quick, what you do is you figure out what you think your income is going to be, including like incremental items that weren't necessarily there in the prior year, like Roth conversion income, for example. And then you apply the brackets to those to get what the estimated tax is for 2024, and then you multiply that by 90% if you want to check out what the amount is under option 1 safe harbor, and that's how we get to this. So this amount is what you would need to pay in for the full year to be covered under the safe harbor for 2024. Now, assume for the moment that there is no overpayment from 2023, meaning you overpaid your taxes, you had an overpayment that instead of getting refunded to you, it was applied to the next year. We'll get into that in a few minutes. Just assume for now that there isn't one of those carrying over to 2024, and also there's no withholding. So the only thing you have, again, is the estimated payments that you would have to make to cover all of this. There's no withholding that would cover part of it. We will layer in withholding in the next example as well. All right, so here's the 41,477. So I'm going to go down here. Here's the 41,477, and I'm going to divide it by the 4 quarters, and I'm going to get $10,369 is what is due by the end of each quarter. Or excuse me, it's due for the quarter ending on these dates as we just discussed. The actual due date of these payments is right down here. This is the URL for where you can find this information right here for the due dates. The due date for Q1, right, which is 3 months long, is due 15 days after the quarter is over, so April 15th. This is 2 months long, as we have said. It's still due 15 days after the end of the quarter. 3 months long, due 15 days after, and then 4 months long, and this is due by the 15th of the following year. Okay, now you might be asking, okay, wait a second. I'm looking at this. I remember what we talked about before. We just went over the fact that these quarters are not all 3 months long. So if Q2 is only 2 months long and Q4 is 4 months long, why is the estimated tax payment the same for each quarter? When I did this up here, why did we just divide this by 4 and put the same amount in each quarter? And the answer to that is because right now we're operating under the IRS default assumption. Nowhere in example 1 have I given any indication to the IRS or to us doing the calculation when that 40,000 Roth conversion took place during the year. I simply said there was going to be a Roth conversion in 2024. And that can often be the case because you may not know exactly when you're going to do the conversion. So here's the key I want you to take away regarding safe harbor option number 1. If your income estimate is going to be reasonably accurate, meaning like you're pretty darn sure it's going to be about $250,000 in this example, and if you're willing to pay 4 even estimates like we just showed above under the default assumption, then it doesn't matter when the Roth conversion happens during the year. If these 3 things are the case, then you will be covered under option 1 safe harbor, and you shouldn't get dinged with any underpayment penalty. So let's make sure to clarify that using the same kind of timeline that we were using before. So here's all of our other income in this example, 210. That's going to be deemed to occur pro rata at 52.5 in each quarter. Here's our conversion income at 40. When does it occur? Well, if we're operating under the default assumption, it doesn't matter when it occurs. It's going to be deemed to occur pro rata throughout the year. Okay, so estimated tax based on this even distribution throughout the year. If we do it based on the 24% marginal bracket, it would be the 62.5, which is 52.5 plus 10, 62.5 times 90% safe harbor, right, for option 1, 24% tax bracket equals an estimated payment of 13.5. Now, we're not actually using 24% to calculate our estimated taxes. We're using the mixed brackets above. I mentioned 24% earlier because if you were just trying to figure out, hey, what what is the actual Roth conversion itself going to be taxed at? Let's just go up here for a minute and take a look at that. If we wanted to know what is the Roth conversion, just that incremental 40,000 going to be taxed at? Well, then we would look at the brackets here and we would say, okay, well, at 210, right, 250 minus the 40, 210, we're already in this bracket right here based on all of our other income, not considering the Roth conversion. So the Roth conversion incremental income will be exclusively in this 24% bracket. So if we wanted to know what the tax effect of doing just the Roth conversion, then it would be 40,000 times 24%. But when we're doing the full estimated tax calc to get the actual payment, it's going to be based on a mixed rate. And so by going down here, you can see that the benefit of the mixed rate is that instead of just a flat 24%, the benefit of those lower brackets is going to get you 62.5 times 90% times a mixed rate, which is too difficult to show in this little box, but we showed it up above. That's how we got to the 10,369 as the actual estimated tax payment, which would be due under option 1, safe harbor. So actual with the benefit of the graduated rates is really 41,477 as opposed to 54,000 if we were just doing a really rough calculation using a flat 24%. The takeaway is, remember earlier when I said that you weren't really sure like exactly when the Roth conversion was going to happen, or you weren't exactly sure it was going to be $40,000 and so forth. If $40,000 is pretty close, but you don't really know when it's going to occur, if you're under the safe harbor, it doesn't matter when it occurs because it's going to be deemed to occur pro rata anyway. Okay, now let's do a concept check here. So what is your risk with option 1 safe harbor? And the answer is it's a potential risk of underpayment. Let's say, for example, you do a Roth conversion in Q4 under the scenario we've just been talking about, and it is more than $40,000. Let's say it's $100,000. Then what? Then under the default assumption, you will be underpaid in Q1, Q2, and Q3. And how do you deal with that? You elect the annualized income installment method like we've been talking about earlier in the video, and you get yourself out of the default assumption so that your estimates will be based on when your income was actually generated. Here is how that would work. So let's say that all year you think your Roth conversion will be about $40,000, and you make your Q1, Q2, and Q3 estimates based on that assumption. Okay, so for Q1, Q2, Q3, your estimates are the same as we've been talking about above. Let's go down here to this little chart. So here's Q1, Q2, Q3, 10,369, the same as we calculated above, because you thought all this time, from Q1 to Q2, Q3, you thought the Roth conversion would end up being 40,000, and you didn't know until Q4 that it was going to be something else. Okay, but then in Q4, you do the Roth conversion, and you decide, for whatever reason, it's going to be 100,000 instead of 40,000. So what just happened? Well, you created $60,000 of incremental income, more than you had originally expected and more than you had originally used to calculate your estimates in the first 3 quarters. Okay, so here's the original 40,000 right here. Here is the additional 60,000 of conversion income. So here is the original payment based only on this 52.5 plus 10 times the 90% safe harbor times the mixed rate. That was the original 10,369. And here is the incremental amount, 60,000 incremental times the 90%. In this case, times 24%, because we already saw a few minutes ago that the impact of the Roth conversion itself all landed in the 24% bracket, gives you 12,960 of additional tax due paid in Q4. So the Q4 payment will be 10,369 here plus the 12,960 here equals 23,329. And then you have to remember to elect the annualized income installment method when you file your tax return at 4/15 of the next year, because that incremental $60,000 again will be deemed to have occurred pro rata if you don't make the election. And then you would be considered underpaid and you would get dinged with the underpayment penalty. All right, let's do another concept check here. In the scenario I just described above, did you pay in too much, too fast in Q1, Q2, and Q3? Let's go back up here and look at the diagram. In this example, based on you assuming that the Roth conversion was going to be $40,000 all year, but then when you got to Q4, it ended up being $100,000. But you paid, based on this assumption for the first 3 quarters, did you pay in too much too fast in these 3 quarters? And the answer is yes, you did. Okay, let's go back down here. Yes, you did, because you paid in based on $10,000 of Roth conversion being deemed to occur each quarter, Q1, Q2, Q3, when really it all happened at the end of the year. Okay, so let's go back up again and make sure we understand that. What you could have done if you had known that you were going to do $100,000 in Q4 and you were going to elect the annualized income method, what you could have done is you could have paid all of the incremental tax on the full $100,000 of Roth conversion here in Q4. And the amount that you didn't pay in Q3, Q2, and Q1, you could have kept in your possession and used for your own purposes, or at a minimum, you just could have kept it in like a risk-free interest-bearing account, earning the risk-free rate of return, as opposed to just paying it into the government too fast. But by going with this assumption all year and making these payments under the default assumption, you effectively paid this in too quickly. The tax on this amount, and this amount, you paid it in too quickly when you could have paid it in at the end with the annualized income method, okay? So you paid it in too quickly, but there's nothing you can do about it once you get to Q4 because those payments have already occurred. So you gave the government a small interest-free loan, basically, for a short time. When you pay in too much, too fast, whether it's through estimated taxes or through withholding or in any way, you are giving the government an interest-free loan because the government doesn't pay interest to you on money that you voluntarily pay in for estimated tax payment purposes. The government will pay you interest on money they owe you if it's a mistake on the government's part. But if you're just sending in estimated tax payments that are too big, they're not going to pay you any interest on that. And so what you've done is you've effectively dinged yourself by, you could have had that money sitting at the sitting in a risk-free account, earning the risk-free rate of return at a minimum. You know what I mean? Or you could have used it for your own purposes. But anyway, in that scenario right there, you overpaid too quickly. Oh well, it is what it is. Usually better to overpay a little bit too much and give an interest-free loan as opposed to getting dinged with the underpayment penalty. But ideally, you'd like to pay in just the right amount. That way you don't give an interest-free loan and you get to keep the money for your purposes and you don't get dinged. And that's what the estimated tax calculator that we'll talk about a little bit later will be designed to do. Now, before we go to example 2, I know that right now, watching this video, I have a few folks in the back row who just heard what I said about avoiding giving the government an interest-free loan and getting out of the default assumption by electing the annualized income installment method. And they're thinking, well, why don't I just always elect the annualized income installment method? Then I don't have to deal with the default assumption at all. And I don't run the risk of paying in too much too early and giving the government an interest-free loan. Well, that may seem like the case, but let's say you do a $100,000 Roth IRA conversion in Q1 for whatever reason. Let's take a look at this timeline. So in that particular circumstance, here's the reality. You did a Roth conversion in Q1. The income of $100,000 was generated in Q1. But under the default assumption, you got the benefit of spreading the income out over the 4 quarters. These $25,000 increments are deemed to occur over the 4 quarters, exactly as we've just been talking about. This is working now in the opposite way. The reality is the income was earned early, but the default assumption spread it out over time. So now the default assumption helps you instead of hurts you. Instead of having your estimated taxes based on $100,000 occurring in Q1 under the annualized income installment method, the default assumption spreads the income out over 4 quarters so you don't have to pay in as much as quickly. Follow? If you elect the annualized income installment method, when you have uneven income and a large amount of it is earlier in the year, like in Q1, you're actually doing yourself a disservice potentially, because now you're taking income that was deemed to be spread out, and you would pay your estimated taxes based on it being deemed to be spread out, and you're pushing it all back into Q1 and making an estimated payment on it back here. So it's not that electing the annualized income installment method is always a good idea. It's not always a good idea, and sometimes it can work to your disadvantage. Here is an even more sneaky situation than what we just described up here. Let's say your financial advisor generates $100,000 of capital gain in Q1. You know, the market's doing well, they sell some, they harvest some capital gain, whatever. But you don't know about it until Q4 because the financial advisor forgot to tell you, and you might be surprised how often that happens. Or maybe you wouldn't be surprised, depending on who your financial advisor is. You were planning to elect the annualized income installment method. Okay, so you were planning to do that. The default assumption spread that capital gain out over 4 quarters. You elect that without even realizing that it occurred, and all of a sudden you've pushed all that income back into Q1. So again, the annualized income installment method hurts you because you were potentially way underpaid in Q1. In other words, if you paid your estimates based on this and this and this and this, and then suddenly you elect this without realizing all this capital gain was back here in Q1, you're underpaid because you only paid based on $25,000 in Q1. Now you have $100,000 pushed back into Q1. So as you've heard me say with everything in tax planning, is the default assumption good or bad? Is the annualized income installment method right or wrong? Is it the right or wrong thing to do? Nothing is right or wrong, good or bad. It's only right or wrong for your facts and circumstances. Okay, let's go to example 2. All right, estimated taxes, example 2. Now, same fact pattern as in example 1. Your 2023 taxes were $50,000. You're planning to do a Roth conversion of $40,000 in 2024. All other income items are expected to be the same. You were in the 24% marginal tax bracket in 2023. How much do you have to pay in estimated taxes for 2024? This time, let's use option 2, 100% of the prior year tax, or 110% of the prior year tax if AGI is over 150, which it will be in our case. Okay, so it's going to be the same fact pattern, but we're going to use option 2, 100% of the prior year. So this method is very straightforward. We don't even need the tax brackets to do this one. So basically the way it works is the total estimate of 2024 tax is $50,000. Remember, that's just an estimate for 2024 based on 100% of the prior year. The safe harbor threshold in our case will be 110% because AGI was over 150. So the safe harbor estimate for option 2 would be 55,000. Obviously, if this was just 100%, for whatever reason, if the AGI was lower, then this would also just be 50,000. But in our case, it's going to be 55,000. So let's go down here. The safe harbor option 2 payment schedule is going to be just like we calculated before. Here's the 55,000. It's 1/4 per quarter, so 13,750. Now, let's add in a couple of other items. Now, what if we have a $15,000 overpayment from 2023 being carried to 2024? This can be found on your 2023 Form 1040 tax return, line 36. So it would be right here, amount of line 34 you want applied to your 2024 estimated tax. So if you look at last year's return and there's a number on here on this line, this applies to you. You have a carryover to the current year. So in this case, your estimated tax safe harbor payment schedule would look like this. Okay, for the first quarter, you would apply the carryover first. Okay, so we had $15,000 of carryover total, but we only need $13,750 to cover the Q1 estimate that we just calculated. Okay, so the first quarter is covered by the overpayment completely. There is no additional estimate that will be required. Now, in the second quarter, there is only $1,250 left of carryover from the prior year. So we apply that first to Q2, and now the full $15,000 of carryover has been exhausted. So we used up most of it in Q1, we used up the rest of it in Q2, which leaves $12,500 needed as an estimated tax payment in Q2, so that way you can get to the total of $13,750. And then because the carryover is exhausted right here, then we just need $13,750 in both Q2 and Q3 estimated tax payments to get the totals we need to arrive at $55,000. Okay, so this is how you apply a carryover. It applies to the first quarter and then to the second quarter and then whatever's left to the third quarter, fourth quarter, and so on before you start making estimates. Okay, carryovers apply first, and then when it runs out, estimated tax payments begin. Okay, now, what if I have withholding in 2024 of $12,000? Okay, this will be the combination of any withholding found on like W-2s, 1099-Rs from pensions or IRA distributions, voluntary withholding on SSA 1099 related to your Social Security, withholding on 1099 consolidated from your brokerage house, or other tax forms, okay, that show federal withholding. Let's just assume all of this accumulates to $12,000 for this example. So in this case, your estimated tax safe harbor payment schedule would look like this. Now, watch carefully. The withholding applies evenly. It applies pro rata to all the quarters. Withholding is deemed to occur pro rata, just like the default assumption for income. All right, withholding does not start by filling up Q1 and then whatever's left goes to Q2. So withholding is evenly distributed across the quarters like this. Okay, now in this case, the carryover still applies first to Q1 and then to Q2. But the difference here is if we go back up to this previous one, there was no withholding. So we needed a full $13,750 of the carryover from the prior year to be used up in Q1. Down here in Q1, in this revised version where we have withholding present, $3,000 of the withholding is applied to Q1 first. So withholding is kind of apply this first. Then whatever's left to reach the $13,750 that we need will come out of the carryover. And in this case, there's enough between withholding and carryover, so no estimated tax payment is required. Now, in Q2, the withholding of $3,000 applies. We have a little bit more of the carryover applied to Q2, although it still gets exhausted in Q2, leaving a $6,500 estimated tax payment that is required for a total of $13,750. And then in the last 2 quarters, we have $3,000 of withholding available, leaving estimates of $10,750 in each quarter to arrive at what we need to get to the full $55,000. Okay, so what I want to make sure is clear now that we're looking at this chart. When I say we're calculating our estimated tax payments, so we go back up here, this right here, this is the total amount that needs to be paid in by Q1, the total amount that needs to be paid in by Q2, etc. But it doesn't necessarily have to come from an estimated tax payment if there is withholding or if there is carryover from the prior year present, or both, as in the case down here. So the $13,750 was the total estimate that was due in Q2 or for Q2, but it really only was a $6,500 estimated cash payment because another $7,250 was covered by withholding or carryover. Follow? Same thing in Q3. This is the total that needs to be paid in, but because $3,000 was already paid in through withholding, it left only a $10,750 payment actually being required. So withholding will be considered first, as we just said, and withholding is deemed to occur pro rata between the quarters. Then you apply the carryover from the prior year to the extent necessary to reach the safe harbor. And then when withholding plus carryover is not enough to meet the safe harbor, that is when estimated tax payments begin. Okay, now let's do a concept check. Think back to the risk we talked about with option 1. It was the risk of underpayment if the Roth conversion you ended up doing in Q4 was more than the originally estimated amount of $40,000. This risk does not exist with option 2 as long as you make your safe harbor payments, because as I mentioned before, 100%, or in our case in this example 110% of the prior year tax is a known amount. It doesn't change. The risk existed with option 1, the 90% of current year tax, because current year tax changed when the Roth conversion amount changes. Okay, so one more time, when you're basing it on 100% or 110% of the prior year, that number is like set in stone. It never changes. So as long as you make the estimates based on that, it makes no difference what your tax ultimately ends up being. Whereas here, if you pay 90% of the current year tax and your estimate of the current year tax changes before the year is up, then you run the risk of potentially being underpaid. That's why I said earlier that this one is like the quote-unquote safer of the two safe harbors. So with option 2, which is the one we just went over, you would never need to elect the annualized income installment method because you're covered no matter what your tax ultimately ends up being. For example, we calculated a $55,000 safe harbor with $13,750 payments due each quarter. As long as those payments are made timely, your tax for 2024 could ultimately end up being anything. Like it could be $300,000, it could be $1 million, it could be any number, and there is no risk of an underpayment penalty as long as you paid in the required amounts by the due dates for each 4 quarters, and it was based on last year's 100%. That is why the last year method is a little bit safer of the two safe harbors. Now, hang on for a second. I said a few moments ago that withholding is deemed to occur pro rata. Okay, so let's think about this. In our original example, with the viewer who posted that she did a Roth conversion in November and she sent in the estimated tax payment right away, this is what really happened right here. Okay, we've seen this chart a number of times now. We're going all the way back to the beginning. This is what really happened. This is what was deemed to have happened, right? Here we elected the annualized income method to get our estimated taxes based on this reality. This is what was deemed to have happened, okay? These charts should look familiar. This is what we went over earlier in the video. Now, here's the thing. All of this was an issue because we're making estimated tax payments. And estimated tax payments are actually one of the few things where the IRS does know and does take into account the date you made the payment, okay? Because that information is known, because in order to make a payment, whether it's online or via the mail or whatever, you have to put a date when you're doing it. And so that date is transmitted to the IRS along with the payment. And so that's one of the rare cases where they do take the date into account when you're making an estimated tax payment. But what if the tax had been paid through withholding instead, i.e. from money coming out of the traditional during the Roth conversion that the broker then withheld and remitted on your behalf? What if this happened instead of paying an estimated tax payment using outside funds? In other words, let's assume that withholding occurred on both the wage income and the conversion income in the above examples, which is the opposite of what we assumed earlier, okay? We're going to assume these are no longer estimated tax payments. So if I scroll back up here, let's assume that instead of being payments, estimated tax payments, all of this is now happening through withholding, okay? We're going to change it up. In this case, the deemed income and the deemed withholding are occurring together, okay? Because withholding is also deemed to occur pro rata. So let's go down here. So now, here is the deemed income for wages. We've seen that before. Here's the deemed income for Roth conversion. We've seen that before. Here are the estimated tax payments that are required on this deemed $60,000. So $60,000 times 24%, $14,400 estimate required each quarter under the default assumption. Now, just like before, the estimated tax payment actually occurred in Q4. Now, the withholding is actually occurring in Q4. The withholding is occurring when the Roth conversion happens. So I have a $120,000 Roth conversion times 24%. So there's $28,800 of withholding occurring that the broker withholds and then remits to the government on my behalf. Now here's the thing. Before, when this was an estimated tax payment and it was occurring in Q4, we got no credit for it back here in Q1, Q2, and Q3, and that's why we had to make the annualized income installment method election so that things could be based on reality, because no credit was given because the IRS knew the date of this payment and it was in Q4. Now, when this is withholding, here's the thing. Withholding is deemed to occur pro rata. So the fact that it actually occurred in Q4 doesn't matter. What happens is you get credit for it down here in each quarter. This is irrelevant, okay? This 28.8 is deemed to occur like this: 7,200, 7,200, and so on across the quarters. So now what's happening is the deemed income is causing that 14,400 estimate to be required, and the fact that both the wage income and the conversion income are being handled through withholding, and the withholding is $7,200 on each one. I'm just assuming it's $7,200 on the wage income for this example. The 14.4 is covered by withholding, even though this 28.8 actually occurred in Q4. So the point is, let's say you know that you owe some tax back in Q1 or Q2. Let's say it's from something unrelated, like a bunch of capital gains that were harvested and no estimated taxes were paid on them and no withholding occurred on them. And then you do a Roth conversion over here, or you have some other type of income generated in Q4 that you're able to do withholding on. If you do the withholding in Q4 and it's sufficient enough to cover the tax that you should have made estimated tax payments on back here, you will actually get credit for that withholding. And why will you get credit? Because unlike those estimated tax payments where the dates are known, the IRS doesn't know what date withholding occurs, and therefore withholding is deemed to occur pro rata. So the takeaway is, when you pay the taxes on the Roth conversion income through withholding, as long as the withholding is enough to cover the full year's amount, in other words, as long as it's 90% of the current year or 100% of the prior year or 110% if AGI is above 150K, then there is no risk of getting dinged with the underpayment penalty because the withholding is deemed to occur pro rata right alongside the deemed income. So does that make paying the tax on the conversion through withholding the right thing to do? You know exactly what I am going to say to that. The only thing that makes it right or wrong is your facts and circumstances. You know, a lot of people are traditional IRA rich, I call them, but they are also outside cash, just sitting around waiting to pay tax on Roth conversions, not as rich in a lot of cases. And because of that, many people choose to use funds coming out of the traditional IRA, in other words, in the form of withholding. But think about this. By law, you can only contribute from outside funds to a Roth IRA a limited amount each year. For 2024, it's $7,000 if you're under 50, plus an additional $1,000 if you're over 50, and it goes up for inflation, each year, but who cares? It's a low number. It's a small amount. But here's the thing. There is no limit on the amount of money you can convert from a traditional to a Roth. So if you are using funds that are coming out of the traditional to cover the tax on the conversion, then you are using up funds that had the potential to be stuffed into that Roth in usually much larger amounts than the annual contribution limits above. So if you're using up those funds instead of using outside funds, you could potentially be shortchanging your family's pocketbook. I mean, think about it. If you use up $75,000 of money it could be over several years, coming out of a traditional IRA to cover tax on conversions, it would take you $75,000 divided by the annual contribution limit of $7,500, which I'm just holding constant for this example. It would take you 10 years of regular contributions to make that up. And I mean, after you're over the age of 59 and a half and you have satisfied the 5-year holding clocks, there's really no better account type out there to have your money in than Roth. Everything will grow tax-free for your lifetime with no RMDs until the Roth ends up in your beneficiary's hands, where it will be subject to a 10-year RMD distribution window, but with no tax effect. By the way, if you are interested in seeing more guidance and examples of how to calculate your estimated tax payments, I have a brand new estimated tax calculator, as well as an all-new 4-part instructional video series that contains a comprehensive example of how to go from your 2023 actual tax return results through your 2024 Roth conversion planning, including calculating any estimated tax taxes that may be due on the conversion. The video series also introduces an all-new Roth conversion tax strategy and Roth IRA balance tracker, which I know many of you have been asking about, where we start crunching the numbers to see how the withholding versus outside funds decision plays out under your facts and circumstances. That 4-part instructional video series plus the estimated tax calculator plus the Roth conversion tax strategy and Roth IRA balance tracker is included with your purchase of the personal tax planning template that you've seen me use throughout this entire video series. So if you are already a member, you can just log into the members area at your convenience and check it out. And if you're not already a member, the personal tax planning template is available for purchase at the link in the description located right below this video on YouTube. Your purchase helps out the channel and gives you a tax planning and analysis tool set that you can use throughout your life to help minimize your taxes and maximize the after-tax cash that remains in your family's pocket. As always, you will get lifetime access to all updates that I make to the template as well as the members area, so it is a win-win for everybody. With that said, I'd like to give you just a little quick preview of what the estimated tax calculator is going to look like. We have our prior year actual AGI, we have our prior year actual income tax, we have our current year projected income tax, which will come straight off of the personal tax planning template, including the impact of your projected Roth IRA conversions. Then we have our safe harbor calcs. We have the 100 or 110% of prior year. Like we talked about earlier in the video, we have our 90% of current year. We have our overpayments applied. We have our estimates of what our withholding is going to be. We have our estimated tax payments. And ultimately, all of this will lead up to the determination of what actually has to be paid when we do Roth conversions. As I mentioned, this Roth conversion video series will now be 6 parts long. We just finished part 5. Part 6 will include a variety of topics, including preliminary discussion of building out our cash flow generating assets to help cover the tax on Roth IRA conversions, as well as a number of other topics which have been brought up by many of you in the channel comments, and I certainly do appreciate that. So please stay tuned for that. I hope you enjoyed this video. Thank you for watching, and I will see you in Part 6.